CPM Group's Jeffrey Christian joins me now at the IPMI conference. Jeffrey, thank you so much for being with me.
It's always a pleasure.
Now, Jeffrey, I need to congratulate you and your firm because I read one of your advisories before Bernanke spoke, and you were anticipating the recent correction we just had. How did you do it?
Well, we look at a large number of metrics in the markets, and what we were seeing was that the gold market and the silver market were anticipating a decline. I mean, you had a lot of people who were shorting the markets. You did not have a lot of people buying markets. Coin premia were weak. Coin sales were weak. Sales were way off in India and China and a number of other markets. So it looked like the market was expecting lower prices. And then what we did is we said, okay, what will be the occasion that could trigger an actual sell-off? We looked at the calendar, and the following week was the FOMC. If you go back to mid-May, Bernanke had a one-line comment in a commencement speech in which he said that the Fed might be looking to taper off the large-scale asset purchases soon, and the bond interest rates rose about 60 basis points just on that one line in a commencement speech. So we thought this is going to happen. The FOMC will come out with a statement saying that they are moving or are looking to start tapering off their purchases, and that would be the big occasion.
But Jeff, do you think it was an overreaction to his statements?
No, I don't necessarily think that. As I said, the gold and silver market, investors in the gold and silver markets had built up record high shorts in the gold market. Investors had built up very large shorts in the silver market. Investors had pulled back from bargain hunting buying. They did not see prices at $13.75 gold or $22, $23 silver as particularly attractive levels. They were looking for a reason to sell metal and to see the price fall lower. And so I don't know that it was an overreaction. I think that it's a very important development in the global financial markets, and I think the markets probably reacted they reacted exactly as we expected.
Right, and everyone is speaking about deflation now. Do you feel that's where we're headed, towards more of a deflationary environment?
No, we don't see, we see deflation. We have been saying for years, since 2010, that deflation was a bigger threat than hyperinflation. And we continue to say that deflation is a bigger threat than hyperinflation. But we don't necessarily see it as a threat that will be realized. What we do see it as is a threat that the Fed and other monetary authorities will pay close attention to. So as they taper off, they'll do it very moderately. Because quite frankly, if we hadn't had these large-scale asset purchases over the last 4 years, we would be in a deflationary environment already. I mean, if you look at econometric models, we've got 2% inflation in the United States. We'd have negative 2% deflation if it weren't for these programs.
So, Jeff, do you think that economists like Nouriel Roubini are on the right track when they're calling for $1,000 gold within the next 2 years?
I don't necessarily pay attention to those guys. They don't look at the fundamentals. They don't understand the fundamentals. Generalists tend to be generalists, and we tend to try to look at the actual realities of the markets and determining things. So, no, I actually, in terms of the view of the market, there's a possibility of a spike down to $1,000, partly because there are a number of technically driven generalists who are looking at it that as a target now. But our view is that on an annual average basis, we're probably close to the lows now in the $1,300 to $1,400 range.
So now what, Jeff, you're saying you were close to the lows. So is this the bottom for gold?
Well, we wrote another piece for our clients last week, last Friday, after the decline, and we said, we have been thinking that there was another leg down to around 1260, and we got down to 1275 last Thursday. And what we were saying was, given that it's going to be very important to watch the market reaction when the price stops falling, to see if there's this bargain hunting like we saw in April. And so far there hasn't been, but we're not sure that the prices stop falling. If there isn't that kind of follow-through bargain hunting that we saw in the middle of April, then I think the market is vulnerable for another leg down.
Okay. So what would it take for a bounce back, Jeff? From what I've been hearing from others is that it's either a major world event or investment demand picking up. Sounds obvious, but do you think there could be another theory?
Well, if you look at the probable causes, what could stimulate it? It has to be a rise in investment demand. A major world event can occur, and if investors don't interpret it as being negative for the global economy, sufficient enough to cause them to buy gold and silver, the prices won't respond. Okay. So, yeah, I think you'd have to see a major market event, a negative economic event, to see the gold price or silver prices rise sharply. But what we're looking for is not so much that, but a marginal shift in investor attitudes away from this irrational exuberance that we're seeing right now about global growth and U.S. growth. And that could lend a little bit of support and take the prices up, not back to 1,600 or 1,700, but maybe back to 1,400.
Jeff, you mentioned the U.S. economy, and yes, there seems to be a rosier picture being painted. Are you bullish on the U.S. economy? We
are not as bullish as a lot of other people. We tend to have a more moderate pace, and we're still looking at a U.S. economy that grows modestly. I think there is over-enthusiasm about economic growth in the United States. We expect to see a tapering off or a leveling off in housing sales, housing prices. Unemployment's decline, we think, will start to plateau. We think unemployment, housing market weakness are going to continue to be problems. We see that the stock market, from our perspective, is rising for a lot of really bad economic reasons. So insofar as people are looking at rising stock prices, and even though they've fallen in the last couple of weeks, they're still very high. Insofar as people are looking at rising stock prices as a sign of economic health, they're wrong. The stock market is rising because corporations are decapitalizing, which is bad for long-term growth.
Finally, Jeff, let's talk Asia. I know you've just returned from a trip there. What are you hearing about investment demand from China? Is it still present?
Chinese investment demand is still present, but it's off. And again, as I was saying, in late April, we saw a very strong response, not only in China, but India, the Middle East, United States, even Europe was buying when the price fell in the middle of April. This time, you're not seeing that. And growth, the demand level in India is said to be less than half of what it was in late April, early May. And in China last week, our major dealers that we talked to were saying that demand is off, anywhere from 40 to 80% from those high levels that we saw in late April.
So why do you think people are not buying there, Jeff?
Primarily because they expect the price to fall.
Okay.
In late April, in early April, the price was 1650, and they were convinced, or 1560. I'm sorry, it was 1560, and people were convinced that a drop to 1320 was a great buying opportunity and a bargain. Now the drop back to these levels, investors are saying, no, maybe the price has lower to go before I step in as a buyer.
But we have seen some important news emerge from Asia recently. We saw the launch of 2 new ETPs, gold-backed ETPs in China. We saw a Deutsche Bank launch a gold vault in Singapore capable of holding 200 tons of gold. Do you think that's indicative at all regarding the appetite for gold in Asia?
Well, there are a couple things. First off, yes. And the appetite for gold and silver will be strong and stay strong in Asia, throughout Asia, but it will be reduced from what we saw over the last few years. Second thing is, you have to remember, in the early 80s, after the peak in the gold and silver prices, you saw a tremendous build-out of capacity to provide precious metals by banks, building new vaults around the world, building new trading departments, all after the peak. And all of those assets were written off over the course of the 80s and 90s. And so what you're seeing now is a lot of people who are perhaps reacting to yesterday's news, building capacity that may not be fully utilized.
Jeff, on that note, I'll make you enjoy the beautiful weather. Thanks so much for being with us.
It's always a pleasure.
And thanks for watching our continuous coverage from the IPMI here in Phoenix, Arizona. We'll have more for you throughout the day. In the meantime, you can email us at newsfeedback@kitco.com or follow this conversation on Twitter @Daniela Cambone. Thanks for watching.